Krishna, Guha, it's great to have you. I do wonder, just putting this week into perspective, how prescriptive you thought the Fed chair was and how much depends on numbers that are still to come.
So you're right. It's been a crazy week, even by recent standards, in terms of Fed signals driving the market up, down, left, and right. I think there's, frankly, a lot of confusion at the end of this. I don't think Powell's signaling was particularly clear and consistent. What was new, of course, is that he certainly came out more hawkish, I think, than many of us had expected. And he clearly put 50 in play for that next meeting in March. The debate, of course, is whether he was signaling a strong default to do 50 or putting it in play alongside 25 with the data to decide. He talked about the employment report Friday, CPI Tuesday. My read has been and remains that he was intending to put 50 and 25 on an equal footing and let the data decide. I think he's saying we need some reassurance from this data relative to the red-hot data that we got for early 2023. It needs to be appreciably more moderate to stick with 25. Otherwise, we'll go to 50. I don't, though, read him as signaling a strong desire to do 50. There are others who see it different.
Right. They have not stutter-stepped like that since, I think, the early 90s at the least, on a 50 to 25 basis. I wonder, do you think doing so would be destructive to the consistency of forward guidance?
So I'm personally not a fan of stepping back up to 50. I think it obviously serves a purpose of indicating that the Fed is willing to respond, even respond aggressively to this apparent turn hotter in the data. That serves a purpose, but it has a real morning after problem. Okay, you did 50, then what? You've got one more inflation print between March and May. If that isn't showing much cooling, do you have to do another 50? More broadly, you're starting once again to outrun your ability to learn from the cumulative data, in particular taking into account the time lags with which monetary policy affects the economy. We still haven't seen the full impact of that very aggressive tightening late last year. I would add, though, that you could advance in 25s and learn along the way and still discover that we do need to go higher. We need to go into the mid or even the high fives, maybe even to 6. We do think the Fed's looking at this strong data and wondering if that famous neutral rate is higher than they thought, and that they might have to go higher over time to that higher peak rate in order to be sufficiently restrictive.
On the other hand, credit card debt is rising. Consumer is slowing down a little bit. I saw that in the Beige Book. Wage growth is moderating. There's some carnage right now in crypto-related economy. The REITs are not having a particularly good month. Manufacturing is not exactly booming, Krishna. So there's evidence that things are slowing, not to mention the fact that the yield curve is now over 100 basis points, 1% for the first time in decades.
That's all 100% correct. And that's really the reason why I personally would favor sticking to 25s unless this next batch of data is seriously hot in the way that the last batch was. And I do expect some appreciable cooling here. With respect to, the economy, there are parts of activity that are cooling for sure. It is the case that the labor market remains extremely tight, and that's a cause of concern to the Fed. Like you, I put a little bit more weight on the price signals coming out of the labor market. The wages have moderated considerably already without unemployment moving up. Yield curve is, I think, warning us that while in principle you can take rates above normal, put on the brakes, cool the economy, and bring everything back into balance and be done, in the real world, it's very hard to pull that off.